Hi there. I will just quickly give you a brief walkthrough about the model. Um, Before we start, one thing like this is a very dynamic model of banking industry at a very granular level. However, if you want any customization, you can contact us after the purchase, and we will be doing it happily for you. Any customization required is possible. Okay. So first seat is index. As you can see, these 11 seats are main seats, and other remaining were working seat. These are the legends. All cells filled with blue are basically inputs. So if you want to change anything in the model, you just need to tweak that blue cells. Next one is like if there is no fill, that's basically formula based or output. And regarding seat naming, if seat starts with O, that means it's fully output seat. If seat starts with I, that means it contains inputs. If seat contains both O and I, that means it contains inputs as well as outputs. And these are the working seats. So I will start with dashboard. As you can see, like this will give you a bird's eye view kind of like how much is your performing loan, deposit balance, and valuation is separately chargeable. If you want it after the purchase, you can just drop a message. Tier 1 ratio, LDR, financial highlights. As you can see, these are just to give you the overall summary. You can choose the year from this drop down and these figures will auto update. Like you can set your model as per the bank actual industry standards. Right now we have set it as per the actual industry. However, customization is again possible. This is nothing but the dashboard inputs. Here also you can just just check the quick view of how your numbers are looking. Anyways, everything is captured in the dashboard. Okay. Next one, now the main seats. The next one is like investment plus direct expenses plus OPEX assumption. As you can see, um, first is your investment. So yearly you can just hard code how much investment you wanna make. Like initial investment I have assumed to be like 2 million and year one 25 million. So as you can see, you can just hard code the figure. If you want, we can also add the debt component as well. But right now it's equity and FHLB. FHLB means the Federal Bank of US. Like you need to have membership with the federal bank. So this is the FHLB stock. If you opt for a like funding from FHLB, this can also be factored. Like right now, 100% is equity. So if I make it 80%, so 20% will come under FHLB, as you can see. So let's keep it equity only. And this is the like injection. For example, in year one or say year three, you put this amount. Now, how do you want to inject? Like as you can see, like for year three, I am injecting entire amount in quarter four, 100%. So this you can tweak accordingly based on your cash requirement, based on your working capital requirement. If you want to disburse more loan, you can check your cash flow statement, like whether you have sufficient cash or not, and accordingly you can decide the injection quarter. Next is like initial expenditure. Like number one is startup cost. This includes basic startup cost. These are the one-time asset infrastructure costs. These are all percentage of the investments made in year one. Office setup, as you can see. Next is contingency and buffer. So whatever amount you utilize out of this investment, as you can see, out of initial investment, so rest amount will go under your cash buffer. This cash buffer or contingency reserve will be used to like take care of direct expenses, OPEX expenses, and so on. Next are the general assumptions. Number one is inflation rate. Based on this rate, your yearly expenses will start to inflate. So we try to keep it as much as realistic as possible. Next one is the corporate tax rate. As you can see, federal average is 21% and state average is approximately 5 to 6%. So effective rate is coming to be around 26. Next one is depreciation. You can change anything like as per your requirement. Next is like expenses assumption. At first we have put the miscellaneous, which is 10,000 per quarter. Next is the very important cost for bank, the cost of funding. Like whatever deposits users gonna make into your bank, you need to you need to return them some interest. So that's basically your cost of funding. These are all annual rates. Next is network and transfer processing fee. As you can see, this I have assumed 0.1%. Technology and cloud data processing, assuming this will be outsourced and 1.5 million will be fixed per year. So that's how it has been made. This will be later distributed into each quarters. So next one is OPEX. This include branch rent, utilities, and so on. And regarding the area, you can choose it from here, and accordingly your rent cost will update. Next is the staffing. So if you want a particular kind of staff, you can keep it. Otherwise, you can make it zero. These are the counts, and these are their average annual salary in USD. These are latest rates procured from various data sources. Again, you can change everything. So the total salary, for example, CO is one CO multiplied by like 275. And since we are starting our operation in quarter 4, so that's why for one quarter only the cost is coming for year one, as you can see. And later this cost is increasing based on the annual increment rate. If you want to provide increment, keep it. Otherwise, you can make it zero. This is FHLB. Like if you add the amount in investment tab, investment sheet, I mean. So here also the amount will start to reflect automatically. Again, if you have any confusion after the purchase, you can drop a message and we will be more than happy to personally connect with you via Zoom call or something and clear out any query you have. Next is like another important thing, the revenue model, the loan to customers on which you will earn interest. So, see, basically what we have done, we have categorized our customers into non-borrowers and borrowers. Okay, and for both these types, we have some yearly budget which we will allocate to like get them onboarded. So, as you can see, for example, year one was 6,500 or 6.5K. So since our operation is starting from year 4, 100% is deployed in quarter 4. And accordingly for each year, like 25,000 is in year 2. So one fourth in each quarter, as you can see. Then we have the leads conversion. So as you can see, like we have assumed average CAC to be 10. If you are like advertising in online platforms, if you are advertising via like offline platforms, it could be any. So new customers acquired is this, as you can see. These are non-borrowers. Initially, they are non-borrowers. They might later be converted to borrowers, but their prime purpose was just to open account. Okay. Next is the budget for borrowers. These people opened account with us with the prime purpose of borrowing. So basically, you have loan consultant, target advertisement, refreshment, etc. So this is the amount basically you pay to those people. So this is your budget, and that's how. This is the borrower's funnel. As you can see, you out of this budget, you will spend your budget based on the type of loan which you want to offer. Like residential mortgage, I am gonna spend 25% of my budget. This is again as per your decision. You can do it as per your requirement. So you will have your spend, you will have your cost per lead conversion rate, and that's how you are acquiring new customers for each type of loan. Like for example, construction loans will may have higher CPL. Right now we have kept it 290, but you can again change this. So that's how you got all your borrowers. So here are all your non-borrowers. Just one second. Non-borrowers, and as you can see, your total customers at beginning was zero. One came via non-borrowers via this budget, and another came via borrowers. And there is a 3% churn rate assumed, as you can see. So that's how. Now we have the interest rates. So we could have kept the same interest rate across all quarters and all years, but as you know, this is a very detailed model. We wanted to keep as much as control possible. So as you can see, we have the interest rate for each type of loan for each type of quarter. For example, if this loan is acquired in quarter one, so this is the interest rate. And if this loan is acquired in quarter two, this is the interest rate. Again, if you want to keep it simple, just keep it same for all quarters. Okay. Next is the general assumptions for loan. This is the average loan size, average loan tenure. This is the CPR, prepayment rate. This is SMM, monthly mortality rate, and QPR is quarterly prepayment rate. So based on this CPR, we computed SMM, and based on SMM, we computed QPR. And again, like provision for bad debts needs to be maintained. So we have assumed like 1% for residential loan will be maintained as provision for credit losses. So I will just explain you for the one loan type and it's same for all others. Like we have opening principal zero, as you can see. We have fresh loan disbursed, and how we are computing this average loan size, that is as you can see 0.8 million for residential mortgages multiplied by new borrowers, as you can see. So that's how we are computing the average loan size. So same has been done in all the loan cases. Next we have deposits. Like we had the cost of funding, right? So based on the accounts that were opened, like these are your customers. So they will have some deposits, right? So this is their cost of funding, and that's how the deposit balance has been arrived at. Next is the investment income. Okay, apart from the interest revenue, bank will make some investments as well, right? So this is your investment goal. Like in year two, how much you want to invest. Year three, how much you want to invest. So right now, this all has been assumed 1 million. You can change it again. So, and this might be in like visible in Indian rupees, but when in Indian format, but when you open it in your system, it will be visible in proper US format. So again, same thing. Like for example, for year two, we wanted to invest 1 million, and entire amount is being invested in quarter one. So here is the amount. Now this 1 million is again divided into five types of investment: treasury securities, MBS, other bank, commercial deposits, purchase of loan pool. So these all are self-explanatory, as you can see. Treasury securities, bank will get at 99%, and redemption can be either at par or at premium. So, and here is the average maturity. So you will earn some income on that. That's how this has been prepared. Again, this is MBS. These all are properly set. You just need to take care of the investment amount. Rates and all are like benchmarked from the industry itself. Again, in case of any query, you can always get back to us. This is the non-interest income like account maintenance, overdraft, loan fees, for forex fees. These are the drivers. These are again inputs, and these are linked figures. So that's how you are computing the non-interest income. This is nothing but the cohort. So these are working seats. And just to give you a like quick brief, like for example, uh, okay, I will explain this in later part. Okay. Next, we have the cash flow statement. Like operating activities, this includes your principal, your interest revenue, your loan disbursement outflows, your taxes, and so on. Next one is investing activities, the amount which you are investing separately. Okay. Next one is financing activities, like this will include your money used to invest in your own business. How did you financed? As you know, there was equity and FHLV advance. And if there is additional capital, that will also reflect. This all you can change it in that sheet itself. This sheet itself. This part basically. So that's it for cash flow. And again, you can check like how much cash balance you have at the end of each quarter. And accordingly, you can decide how much you need to invest. And yearly view is also there. All figures are in USD millions. Next are the ratios, like we have profitability ratios both at quarterly and annual level. Cost mix ratio is also there. Capital ratios are also there, like tier 1 capital, total capital, as you can see. This again, these are working sheets. I will just explain you. Just one. Okay, I will explain you for residential mortgages. See, for example, uh, in that loan to customer sheet, you disbursed this much amount. So the interest needs to be computed on cumulative level. Then you disbursed on like quarter six this much amount. So everything is getting into cohort so that you arrive at the perfect interest and revenue. Okay. So that has been done for all types of loans, as you can see. Now I will explain you the P&L. P&L is prepared as per the US GAAP standards. Line items nomenclature used are like as per the industry. Again, we both have quarterly as well as yearly view. As you can see, we have revenue, we have provision for credit losses, on interest incomes, non-interest expenses, profit before tax, taxes, profit after tax, and so on. Similarly, we have the statement of assets and liability, which we call balance sheet, at quarterly level as well as at annual level. And there is a check mechanism as well. If there is no difference, that means our everything, our all calculation, all are perfect. So, and again, you can separately request for valuation, and we will be happily we can happily go on a call with you to explain this all over again in case you have any queries. Thank you so much.